Ryan here from Mortgage Choice, and today I want to talk about bridging loans. What are they? How are they useful? And what to look out for? If you're new to the channel, please remember to like and subscribe. Are you currently in a position where you are thinking of buying your new property, but you are dreading selling your existing one? What if the settlement periods don't match? Am I potentially going to be homeless? These are commonly the hesitations we hear from customers when embarking on a journey to purchase their next place. You might need help bridging that period between purchasing your new place and selling your existing one. Welcome to bridging loans. A bridging loan is a special type of loan that covers the financial gap between the purchase of your new property and the sale of your current property. What's great about a bridging loan is that it gives you the flexibility to buy a new property before you've sold your existing property. So it gives you more control and takes the stress out of having to align the sale of your current home with the purchase of your new home. So how do bridging loans work? Let's look at Thomas's situation as an example. Thomas is currently living in an apartment in Sydney, but he's been looking to move into the suburbs to a house. Before he's able to sell his apartment, he finds the perfect home. He really doesn't want to miss out on the chance to buy his dream home, so he applies for a bridging loan. Thomas initially took out a home loan for $600,000 to buy his apartment. For his new house, Thomas is approved for a new loan at $1 million. So he now has a combined home loan balance of $1,600,000. This is known as the peak debt, which is the period in time where you hold both properties. During the bridging loan period, and while he waits to sell his apartment, Thomas makes principal and interest repayments on his end loan, i.e. the $1 million loan, which is the expected end debt. During the bridging loan period, repayments for his existing $600,000 loan are capitalised or accrued to his loan on a monthly basis. After 6 months, Thomas sells his apartment for $650,000 and pays his old loan of $600,000. He pays the bank the accrued interest of, let's say, $15,000, and he puts the remaining $35,000 in profit towards his new home loan and reduces it from $1 million down to $965,000. Thomas can now continue paying off his home loan with normal principal and interest repayments. This is a bridging loan in a nutshell. Now let's talk about what to look out for bridging loans. There are usually special conditions attached to the time frame, like paying higher interest rates if the property is not sold in time. Interest is charged daily, so the longer it takes you to sell your property, the more interest your loans will accrue. Does your lender allow you to capitalize interest on your existing loan? If your lender does not allow you to capitalize interest, you may be forced to make interest-only repayments on the peak debt, as well as principal and interest repayments on the end debt. This is not a traditional bridging loan. Another thing to be mindful of is that you typically pay a higher interest rate during the bridging loan period on your existing loan, the $600,000 in our example. In saying this, bridging loans are still a great way to protect yourself in the event that you cannot match the settlement of your existing residence and the settlement of your new residence. We tend to advise clients to have a bridging loan to fall back on. Are you eligible for a bridging loan? Well, first of all, you must have equity in your home, generally more than 20%. When there is an expected end date, generally you cannot exceed 80% of the new property's value. Now, I hope that you have found this information useful, and please feel free to reach out to us should you require advice on your individual circumstances. Look forward to talking to you soon.